What's up, trading family? Your boy Wildcard, riding the Thursday tape with the one and only TB. Quick daily lock-in. Before we put a single dollar to work, nothing we say is financial advice. Do your own homework. Protect your own capital.
Standard disclaimer from my end too. We're two guys breaking down what we see, not telling anyone what to do. Now the tape. SPY hovering around 744. Q's dead flat. VIX at 16.7. Oil at $72.87. That sounds calm. It's not. Iran's ceasefire collapsed. Trump said they called wanting a deal, but he doesn't trust them. And the overnight setup has crude refusing to spike, but also refusing to fade. The whole session is a gap between war headlines and wait-and-see price action.
That gap is everything, bro. Headlines scream, war. Tape whispers, hold on. SPY tested 740, dropped hard yesterday on the ceasefire is dead scare, rejected at 745. VIX kissed 18, then faded right back. Oil stuck at $73, not 80, not panicking. Feels like the market priced a headline event and then just sat there.
Let me ground it with the actual Trump quote because it explains the gap. Last night, he said Iran called wanting a deal so badly, but he doesn't know if they'll honor it. He also said we hit them 20-1. That's a guy negotiating through force, not a guy sprinting to total war. Meanwhile, a Bloomberg analyst framed the Strait of Hormuz as Iran's new nuclear weapon. Forget a bomb, block 20 million barrels a day, and you collapse global supply. That threat hasn't been fully priced into volume. Oil options are still relatively cheap. So the tape is caught, the headline flow says escalation, the quote says talks resumed, and nobody knows which side wins by Friday.
That's exactly the tension I want to sit with, because here's what the market isn't connecting yet. FOMC minutes dropped yesterday. A few members saw the case to hike during a war. At the June meeting, the INCY then said, the Iran conflict leaves an inflation scar through 27. That's a structural scar, not a 4-week blip. And Warsh is ending forward guidance. The Fed is going unscripted. So if Trump's quote opens a window to talk, oil backs off. The energy rotation looks fragile. If Hormuz gets weaponized, we break 75 and nobody's ready for 80.
The Warsh piece is the sleeper. Until yesterday, the whole correlation trade rested on the Fed pre-committing. Bad data meant a cut was coming, so it was good for stocks. Warsh just torched that link. Now if CPI is hot Wednesday, nobody's going to hand-wave it with a dovish statement. The market has to price its own rate path. With the IMSCAR running through 27, that path probably includes a hike probability that wasn't there a month ago. My wave trader algo is seeing this in a purely quantitative way. Yesterday's signal funnel screened out 322 candidates. The VIX gate was clear on a bunch, but perspective gain filter rejected almost everything. The model is saying setup quality is garbage across the board. That's the quant version of this macro transition.
TB. That's the exact kind of insight people miss, and my TFT algo picked up on it without knowing a single headline. It added Eli Lilly near 1200 and INCY near 118 yesterday. Pure healthcare. Zero energy. The system didn't read the FOMC minutes. It just saw the data cleaning up in biotech and pharma, while tech momentum signals got rejected. That's the quiet rotation the sector board is screaming. Energy up 4.7% in a week. Healthcare up 2.3, financials up 2.5, tech down 4.8, consumer discretionary down 1.7. That's a huge weekly divergence. But is it a regime change or just a squeeze off a 90-day base? I say it's a setup that still needs CPI to confirm.
I'll push back on the 2 standard deviation framing because the math doesn't back it yet. Energy's 4-day pop is off a 90-day stretch where the energy sector ETF was dead money. Run the Z-score on weekly returns over the last year, and you'd need more than 1 week to call it 2 sigma. It's notable, maybe 1.2 sigma, but it's not regime change territory. The fundamental case is better than the technical case. Inflation scar, supply threat, unscripted Fed. But the momentum signals that my system uses aren't there. It has zero energy exposure because energy didn't have momentum before this week. If I'm fading anything, it's the people calling rotation before the energy bid survives CPI.
And that's the cleanest argument for staying on the sideline. On my gut call account, I'm pure cash. I learned the hard way. Chasing the energy sector ETF earlier this year, peace trade narrative flipped overnight, and it stung. That diamond hands instinct is real. But right now, opportunity set isn't screaming my name. I'm watching Pepsi earnings pre-market today. Heavy because if PepsiCo shows weak demand, that's the consumer cracking, which is the recession side of stagflation, not the inflation side. If they hold margins, that's stagflation. Costs up, pricing power intact.
On China, the cross current is just as messy. CPI printed 1.0% against a 1.1 consensus. PPI 4.1 matching consensus, but accelerating sharply. That's disinflation on the consumer. Energy cost pressure on factories. The People's Bank of China has room to ease on CPI, but cutting into a PPI spike just cheapens the yuan. That feeds into the one story. SK Hynix 8er sale was 7 times oversubscribed, which sounds bullish but means dollar-denominated buyers are hedging the underlying KOSPI shares. The one intervention bounce to 1500 is a band-aid. When the hedging unwinds, the currency slides and Korean equities feel it. My Wave Trader algo has no direct Korea exposure. My paper account is holding BYD from $87.15, down a few bucks, still intact on the PBOC easing room and the EV unit demand. Not adding, not cutting. It's a thesis monitor.
And that BYD thesis actually got strengthened by the CPI miss. China can juice credit if domestic demand stays soft. Pentagon label noise was nothing. As for my TFT algo, I'm sitting on 110,000 equity, 7 positions, all long heavy healthcare, Eli Lilly and INCY exactly, and 0 energy. That alignment with the sector board's healthcare bid tells me the defensive accumulation isn't just a headline trade. It's the slow money moving before the narrative catches up. I'm not calling a healthcare monopoly, but the system is seeing something durable.
Worth noting, healthcare's quiet 2.3% gain this week feels more sustainable than energy's 4.7 pop because it's non-cyclical, pricing power even in stagflation. Eli Lilly's weight loss drug pipeline is the kind of thing that prints revenue regardless of interest rates. INCY has oncology franchise and M&A premium potential. Both screen clean on my system's long-only momentum filter. But if the Fed actually hikes, valuations compress across the board, and the defensive bid could fail just as fast as tech did. We'll know Wednesday.
That's the binary. CP. I confirm stagflation, healthcare, and staples lead for weeks. CP. I comes in soft, and Warsh goes hawkish anyway? That's a mess. No sector escapes. Let's knock out earnings. Nothing notable this week. That out. No manufactured coverage. Moving on. Economic calendar is where the real weight sits. Tomorrow, Japan. PPI. Consensus, 6.8% year-over-year, prior 6.3. That's pipeline inflation for Asia. Saturday, German final C. PI, 2.3% unch. Nothing to shake Europe. Tuesday, UK retail sales monitor, prior 3.4. But Wednesday, July 15th is the marquee event, United States CPI. No consensus yet, but prior year-over-year 4.2%, core 2.9. That combined with a Fed that just went unscripted is the volatility event of the month. Also, NFP small business optimism that morning. Everything else this week is noise. Wednesday, CPI is the domino. Sector rotation, leaders, the energy sector. ETF plus 4.69, the financial sector plus 2.54, XLV plus 2.29. Laggards, XL, Y minus 1.69, XLI minus 2.6. The tech sector, minus 4.79. The defense is on, but don't chase energy until CPI confirms the bid. Healthcare's quiet lead is what my book is aligned with. XLV could lead for weeks if inflation data stays firm.
International overnight, Nikkei plus 1.38, Shanghai plus 1.16 on China stimulus hopes. Hang Seng down 0.7, KOSPI plus 0.62. Europe flat, DAX plus 0.18, FTSEs down 0.51, Euro Stoxx 50 up 0.58. FX, dollar yen down 0.11%, dollar index down 0.06. Carry trade unwind risk is muted. The China link to the US is through the PBOC's room to ease, which adds pressure on the yuan and indirectly the won. That feeds the SK Hynix order overhang still weighing on tech sentiment. Energy bid supported by overnight calm. BYD thesis intact, tech-heavy, energy light.
Portfolio hot news. The theme touching our book hardest is healthcare defensive accumulation. We've covered the drivers. Inflation scar through 27, Fed no longer backstopping growth, shift out of long-duration tech into inelastic demand. Healthcare up 2.3% this week while tech bled. Bull case, Eli Lilly. Weight loss drug pipeline and pricing power. INCY oncology franchise with M&A premium. Bear case, if Fed actually hikes, valuations compress and the rotation fails. Second order effect. Capital flows out of tech continue. XLV could lead for weeks. My TFT algo added Eli Lilly and INCY yesterday. No energy. TB's Wave Trader algo has zero energy. Heavy tech and healthcare. Gut books. Me cash. TB holding BYD as thesis monitor. We're not chasing. We're watching the setup unfold into CPI. What we're watching tomorrow? Oil break above 75 or hold 70 floor. SPY support 740. Resistance 745. VIX, if it breaks back above 17. Risk off accelerates. The energy sector, ETF's 5-day green streak, that would be 5 in a row, and Wednesday, CPI. The big domino that either confirms or kills the rotation. That's the whole board.
Solid. Stay nimble.
That's the show. Until next time, trade sharp, trust your levels, and don't let the headline noise shake you out of a clean thesis. We out.